Have you ever wondered why governments around the world keep borrowing more money, even when they're already deep in debt? It sounds risky, right? But there's more to this story than meets the eye. Today, we're diving into the complex world of government debt to understand why this trend continues and what it really means for our future. Over the past few decades, the world has witnessed a dramatic rise in government debt levels, and this trend isn't limited to a few countries. It's a global phenomenon. Take the United States, for instance. Its national debt has now crossed $34 trillion, exceeding the size of its entire economy by over 120%. In Japan, the situation is even more extreme, with a debt-to-GDP ratio above 250%, the highest among developed economies. And many emerging markets, including India and Brazil, are also accumulating debt at a rapid pace. At first glance, it's tempting to blame this surge on economic crises, the 2008 global financial meltdown, the COVID-19 pandemic, or more recently, geopolitical tensions and supply chain disruptions. Indeed, these crises led to emergency fiscal measures like stimulus checks, bailouts, and unemployment benefits, all of which were funded by increased borrowing. But the reality is more complex. The rise in government debt is not just a response to crises, it's also the result of deliberate policy choices and long-term structural shifts in the global economy. Since the 1980s, global interest rates have been on a long-term downward trend. Central banks from the US Federal Reserve to the European Central Bank and India's RBI have consistently lowered rates to stimulate growth and prevent deflation. This happens because when borrowing becomes cheaper, governments are more likely to take on debt. After all, the cost of servicing it, meaning interest payments, becomes manageable. For many years, the interest rate on government bonds was lower than the GDP growth rate. In such a scenario, debt actually becomes easier to sustain over time, even as it grows. Over time, the dominant school of economic thought has shifted from fiscal conservatism, which says keep deficits low, to a more Keynesian mindset, where borrowing during downturns is not only acceptable but necessary. After the 2008 crisis, central banks realized monetary policy alone couldn't do the heavy lifting. That's when fiscal stimulus funded by debt became mainstream again. Even institutions like the IMF and World Bank, which once advocated austerity, now often support strategic deficit spending to promote growth and reduce inequality. The post-pandemic era reinforced this shift. Governments spent aggressively to save lives, support incomes, and prevent mass unemployment, even if it meant ballooning deficits. In many advanced economies, populations are aging rapidly. Japan, the EU, the US, and even China are seeing a shrinking workforce and rising number of retirees. This leads to higher spending on healthcare, pensions, and social welfare. At the same time, a smaller working age population means slower growth in tax revenues. Governments have to spend more while earning less, resulting in chronic budget deficits and more reliance on borrowing. In emerging markets, the debt story is different but equally structural. Governments often borrow to finance infrastructure, education, and digitalization investments that are expected to boost long-term productivity. However, weak tax bases and frequent revenue shortfalls mean even capital expenditure ends up being debt-financed. India's budget, for instance, consistently runs a fiscal deficit near or above 6%, largely to fund capital and welfare spending, especially in rural areas. Another enabling factor is that central banks have become major buyers of government debt. Through policies like quantitative easing, they create artificial demand for bonds, which keeps yields low. In effect, central banks help governments borrow cheaply, even when private investors might demand higher interest rates. This suppresses market discipline and allows governments to run larger deficits without immediate consequences. But hold on, you might be thinking, what happens when central banks buy government debt? Where does that debt go? Well, when central banks like the Federal Reserve, European Central Bank, or Reserve Bank of India conduct quantitative easing, they buy government bonds in large quantities from banks and financial institutions. These purchases are done using newly created digital money known as central bank reserves. The goal is to increase liquidity, lower long-term interest rates, and stimulate the economy. When the central bank buys these bonds, it holds them on its balance sheet as assets. The government pays interest on this debt to the central bank. However, most central banks are publicly owned. Any profits the central bank earns, including interest, are usually returned to the government treasury. So, in effect, the government is paying itself a large part of that interest. When governments become heavily reliant on borrowing, it can lead to or worsen inflationary pressures in the economy. When a government borrows money by issuing bonds, it uses those funds to spend on welfare, infrastructure, salaries, subsidies, and so on. This increases the overall demand in the economy. If the supply of goods and services doesn't rise at the same pace as government spending, prices start to rise. This is called demand pull inflation. In many cases, central banks buy government bonds to keep interest rates low through quantitative easing. This effectively injects new money into the economy, increasing the money supply. More money in circulation equals to higher risk of inflation. As debt grows, interest payments become a major part of government spending. To cover these costs, governments might borrow even more or print more money. Both actions can fuel inflation. If investors and consumers feel a government is borrowing too much without control, they might lose trust in the value of the currency, leading to higher inflation expectations. This can make inflation worse through a self-fulfilling cycle. Debt itself doesn't always cause inflation. But when governments borrow excessively and rely on central banks to support that borrowing, it increases the risk of inflationary pressure, especially if the economy is already running close to full capacity or supply chains are constrained. To truly understand why the world seems addicted to debt, let's explore two of the most heavily indebted yet economically stable nations, the United States and Japan. Both countries carry colossal levels of public debt, but the way they manage it and the risks they face are quite different. As of 2025, US federal debt exceeds $34 trillion, more than 120% of GDP. Despite this, the US maintains strong investor confidence because the US dollar is the primary global reserve currency. This means that foreign governments, institutions, and investors are eager to hold US Treasury bonds as a safe, liquid, and trusted asset. The US Treasury market is the largest and most liquid in the world. Foreign central banks like China and Japan, global pension funds, banks, and corporations all hold treasuries. This results in consistent demand for US debt, which keeps interest rates low despite high issuance. But now, with rising inflation and higher interest rates, America faces a problem. The cost of debt servicing is growing. It now spends more on interest payments than on its entire defense budget. Meanwhile, across the Pacific, Japan tells a different but equally fascinating story. Japan holds the world record for public debt over 250% of its GDP, but has avoided a debt crisis for decades. But how? The secret lies in who holds the debt. In Japan, most government bonds are owned by domestic investors, banks, pensions, and even everyday citizens. This means Japan doesn't rely much on foreign lenders, and it avoids the pressure of global markets panicking. In fact, the Bank of Japan itself owns a huge chunk of this debt, buying bonds to keep interest rates near zero or even negative for years. This has made borrowing cheap and stable, but at a price: low economic growth, an aging population, and a growing dependence on central bank support. Japan isn't facing a storm, but rather a slow squeeze. As more citizens retire and fewer young people enter the workforce, the tax base shrinks, making it harder to sustain rising debt in the future. So here we are, two nations, both deeply in debt, yet still standing for now. One relies on global trust and dollar dominance, the other on domestic savings and social cohesion. But both walk a fragile line, because when interest costs rise, or growth slows, or trust begins to erode, the very structure that kept this debt pyramid stable can begin to crack. And the question that lingers isn't whether they can keep borrowing, but how long they can do so without consequences. Instead of leaning on debt, countries start investing in their foundations: education, technology, and renewable energy. They begin by reimagining education, not just more schools, but smarter ones. Curriculums are updated to reflect the needs of the future: coding, climate science, financial literacy, AI, and ethics. Vocational programs train workers for green jobs, digital trades, and high value services. As the population becomes more skilled, productivity increases. Higher wages, stronger job markets, and a more innovative workforce create natural economic growth, reducing the need for constant fiscal stimulus. Next, governments double down on technology. They create startup incubators, fund research and development hubs, and digitize public infrastructure. With AI improving supply chains and automation reducing inefficiencies, economies become leaner and more efficient. Instead of borrowing to plug gaps, innovation begins solving problems from the ground up. And then, the energy transition accelerates. Rather than spending billions importing oil and gas, countries harness the power of renewables. Solar farms bloom across deserts, offshore wind turbines spin along coastlines, and investments in hydrogen and battery storage reshape the energy grid. Clean energy not only creates jobs, but also lowers healthcare costs by reducing pollution and boosts national security by cutting reliance on foreign oil. This strategy isn't just about economic growth, it's about economic independence. It's a model where future generations inherit opportunity, not obligation. The debt may still exist, but its role begins to shift from lifeline to leverage. Governments borrow not to survive, but to build. Build schools, build solar fields, build a future. And in doing so, they trade the addiction of debt for the discipline of sustainable growth. So the big question isn't just, will governments stop borrowing? It's, can they shift from debt addiction to disciplined investment? Thanks for watching. If you found this breakdown helpful, don't forget to like, share, and subscribe. It helps the channel grow and reach more curious minds like yours. We've talked about the debt puzzle, now it's your turn. What topic do you want us to explore next? Drop your suggestions in the comments. We read every single one. Until next time, keep questioning, keep learning, and keep building your financial wisdom.